Welcome to the debate. So today we're diving into Verizon Communications, or VZ. And this is a company that I think really embodies a core tension you see in investing right now. Massive, almost unbelievable financial power clashing with some really intense structural competition.
It's a profound disagreement, really. The central question we're tackling is, well, should Verizon be valued as the secure, high-yield infrastructure play? I mean, based on its massive and, undeniable free cash flow generation. Or does it have to be heavily discounted because its competitive position is eroding and its growth strategy, especially in things like AI and edge, just seems totally unproven?
And I'm going to argue that VZ is fundamentally undervalued. I mean, the market is pricing it like it's a dying tech stock, when in reality, it's an essential, resilient piece of infrastructure that's just now hitting a financial inflection point. And that stability, well, it positions it for a really compelling total return over the long haul.
And my position is that while, yes, that dividend yield is attractive, the company is facing some deep competitive threats and really critical execution risks that severely limit its upside. At best, it's a modest income hold until management actually proves it can grow the business again.
Okay, so let's start with the financial reality. The pessimism in the market right now is, I think, irrational. You can see it in a PE multiple that's sitting well below 10. The core of the bullish argument really rests on the normalization of this massive CapEx cycle from the C-band 5G build-out. We are past the peak spending phase.
The cash flow numbers, I admit, they certainly look compelling. I just worry we're celebrating what might be a temporary reprieve instead of recognizing a much deeper structural problem. Yes, CapEx dropped sharply, I see that. It went from, $26.7 billion in 2022 to a projected $17.1 billion in 2024. That's a $9 billion annual saving, which is substantial.
It's more than substantial. It's a game changer, an immediate material catalyst. The result of that is a structural rebound in free cash flow that delivered $19.8 billion in 2024. That cash flow fully covers the $11.2 billion in dividends they paid out.
Right, with a payout ratio around 58%, yeah.
Exactly. So that 6.5% plus yield is highly sustainable. And on top of that, the cash flow guarantees they can gradually pay down that formidable $143.9 billion debt load, pushing the net debt to EBITDA ratio down towards 2.3. This financial strength alone justifies, in my view, a DCF-derived fair value of $60 to $62 a share.
And that focus on the cash flow is definitely the strongest part of the argument. The numbers are undeniable. But I worry we're focusing on a legacy strength while completely ignoring the deterioration in the core mechanics of the business. My primary red flag, the thing that really stands out to me, is the collapse in subscriber growth. I mean, that's your leading indicator for long-term cash flow erosion.
You're referring to the 2024 numbers, the postpaid phone net adds. It was only 82,000.
Precisely. 82,000. Now compare that dismal figure to T-Mobile, which added over 3 million subscribers. That's a staggering 37-to-1 performance gap. And this isn't just some cyclical noise, related to network timing. This is a structural problem. It's rooted in a failure of marketing and a real competitive disadvantage.
I see why you emphasize that gap, of course. But I think the nature of the loss matters more than the raw volume. Look, we are trading low-value volume for margin resilience. Verizon still leads in the high-value metrics. Just look at the average revenue per account, or APAR, for the consumer segment. It's $147.50. That is significantly higher than its competitors. Our focus on that premium segment, which is backed by network quality awards from OpenSignal and RootMetrics, protects our high EBITDA margin, which is solid, between 34 and 36%.
But trading volume for margin isn't enough when the sheer number of losses is accelerating. And it's accelerating because of the structural threat from the cable mobile virtual network operators.
Can you clarify that for our listeners? What's the specific mechanism that makes these cable MVNOs so threatening?
Of course. So these cable companies, Comcast, Charter, and others, they're what we call mobile virtual network operators. They're basically competitors who are using Verizon's own high-quality network on a wholesale basis. And this allows them to exploit a superior structural cost advantage.
because they don't have to bear any of the massive infrastructure capex that Verizon just spent, what, $26 billion on? They captured 75% of the entire industry's net additions in 2024. They're exploiting price sensitivity, especially in lower income segments. And if Verizon's churn rate, which is around 0.9% right now, if that continues to creep up, and if competition forces even slight price concessions, that impressive free cash flow will erode very, very quickly.
I acknowledge the serious nature of the MVNO threat. I do. But what's your preferred strategic response then? Because I see the strategic acquisition of Frontier Communications as the only real way to counter their advantage in customer stickiness. This $20 billion move is designed to expand our fiber footprint to 35 to 40 million premises, and that enables fixed mobile convergence, or FMC.
And how does that convergence strategy actually address the cable threat?
The key here is creating high switching costs. So, fixed mobile convergence is the strategy of locking in customers by bundling their mobile service with high-speed home fiber internet. And the data shows that converged customers have a 40 to 50% reduction in churn. Why? Because the switching cost of having to change both your phone carrier and your internet provider just become too painful. This fiber investment is a necessary, long-term strategic play to build in the stickiness that directly mitigates the cable advantage.
Okay, I agree that FMC is strategically sound on paper. But let's look at the financial consequences of that $20 billion investment in Frontier. You're trading current financial certainty for future execution risk. That $20 billion investment directly delays the fundamental objective of deleveraging. Management explicitly postponed share buybacks, a critical catalyst for equity holders until they reach their target leverage ratio of 2 to 2.25. Adding this new debt burden just pushes buybacks, the one mechanism that could quickly catalyze multiple expansion, further and further out. It demands perfect, complex execution on the Frontier integration just to justify the delayed balance sheet improvement.
I don't think it simply delays the goal, it integrates the solution. The rapid deleveraging is still guaranteed by the normalized capex and the free cash flow generation. The difference is we are using some of that capacity to invest in a business that fundamentally improves the competitive viability of the core product, instead of just immediately returning cash to shareholders. The improved churn from fiber conversion will pay for the Frontier integration over time.
Perhaps. But let's shift focus from the core market to the future growth narrative. You emphasize the upside from this AI Connect strategy, and you point to a $40 billion AI total addressable market.
Well, it's the classic picks and shovels play for the AI gold rush. We are uniquely positioned to benefit from the demand for low latency, high bandwidth compute that's needed for edge AI applications.
Conceptually, yes, but the hard data completely contradicts the hype. We're talking about partnerships like AWS Wavelength, which has been live since August 2020. That's over 4 years ago, and there has been zero material revenue disclosure related to this critical edge computing initiative. That is not just disappointing, that is a fundamental indictment of Verizon's ability to commercialize its own infrastructure. It suggests the hyperscalers are either bypassing the telcos entirely or market demand is just too weak to justify the investment.
That is a fair challenge regarding historical execution, and that is precisely why the investment case is changing now. The timing is essential here. Management recognized that operational failure and they acted on it. The new CEO, Dan Schulman, was appointed specifically to shift the strategic focus. His mandate is crystal clear. Move the company from infrastructure build-out, which the previous CEO completed, to monetization and digital growth. His vast experience at PayPal is specifically meant to address that execution gap and accelerate commercialization.
I'm just not convinced a CEO change alone generates revenue, especially one who lacks traditional telecom experience, which introduces a whole new type of operational risk. Look, while the strategy supported by partnerships with NVIDIA for GPU platforms is sound, the execution risk remains incredibly high. The base case DCF analysis assumes only a modest, 1.8% long-term revenue CAGR. To achieve your bullish outcome, the $74 per share valuation, VZ has to successfully capture a massive portion of that AI and edge market. We're talking $15 to $20 billion in new annual revenue by 2030. The current metrics just do not support that leap of faith.
But I think we're missing the crucial implication of the current low valuation. The market is pricing VZ so conservatively at a 9 times PE, which is a 30% plus discount to the sector median, that the entire AI and edge opportunity is essentially free optionality. You're paying for the secure, high-yield cash flow stream, and you're getting the potential for massive AI growth at no extra cost.
But free optionality is only valuable if the base case provides an adequate return. If the AI thesis fails, the return is just defined by modest dividend growth and this ongoing street fight against the cable MVNOs. That makes it a low-growth, low-appreciation story, regardless of the strong cash flow. Equity investment demands upside catalysts, and the only certainty right now is that the debt pile and the competitive pressure remain very heavy.
I disagree. Our bear case scenario, which assumes intensified price wars and a complete failure to monetize the AI segment, still results in an intrinsic value between $38 and $48 a share. Since the stock is trading around $40, the downside risk is extremely limited. We have a clear margin of safety, and any partial success, any stabilization of subscriber growth, combined with even a fractional capture of the edge market, well, that results in massive multiple expansion.
And that stabilization is precisely where all the risk lies. The competitive landscape is not static. If the new leadership fails to deliver a compelling product differentiation, that downside floor will not hold, because the free cash flow will eventually be compromised by continued customer flight.
My thesis remains firm. Verizon is a defensive income play first and foremost. The strong FCF generation projected to stay above $19.5 billion annually, and that sustainable 6.5% plus dividend provide a substantial margin of safety. With the CapEx cycle normalizing and new leadership focused on monetization, the infrastructure investments in fiber and the 5G network offer compelling catalysts for eventual multiple expansion. The current undervaluation is just too extreme to ignore.
And I maintain that Verizon is fundamentally a hold, not a buy for appreciation. Its financial resilience is a legacy asset. It's the product of massive historical investment, and it's currently masking a structural failure to compete on subscriber growth. The 4-year lack of material revenue traction in high-growth segments like AI and edge means the value proposition relies almost entirely on dividend compounding. Until those execution risks are clearly mitigated, investors are buying a stabilized utility, not a growth stock.
I think this analysis really highlights the fundamental choice facing investors today. It's a choice between prioritizing the certainty of current financial strength and stable, high returns provided by an undervalued infrastructure giant versus aggressively discounting the company for future competitive and execution headwinds.
Exactly. We both agree the company is a cash flow giant, but we disagree sharply on its ability to turn that operational strength into competitive relevance and, profitable future growth. That disagreement over execution risk is really the key to defining its true intrinsic value.